Hundreds of thousands of people are moving out of states like New York, New Jersey, and California, and planting roots directly in Broward and Miami-Dade counties. That massive population surge has flooded the local real estate market with new capital. Buying an income-producing property here is a fiercely competitive contact sport. If you are a first-time investor stepping into this arena, you face an immediate decision. Do you buy a simple single-family rental home, or do you scale up to a multifamily property like a duplex or a fourplex? This table breaks down the baseline appeal of both routes. Single-family homes are generally easy to finance and manage. Multifamily properties give you multiple income streams and a much faster path to scaling your portfolio. If you spend 5 minutes online, you will find endless videos selling multifamily investing as an easy, stress-free path to passive wealth. The math actually shows something different. Multifamily properties do offer superior downside protection, but only if you know how to navigate the specific, margin-crushing operating hazards unique to South Florida. To succeed in Miami and Broward, you have to throw out the generic internet formulas. You are trading simplicity for strict, highly localized underwriting. For a beginner with limited capital, the most mathematically advantageous way to enter this market is a strategy called house hacking. The mechanics are straightforward. You use an FHA loan to buy a duplex, triplex, or fourplex. You live in one of the units yourself, and you rent out the remaining units to tenants. By doing this, you secure a property with a drastically lower down payment than a standard investment loan requires, and the rent collected from your neighbors directly offsets your own living expenses. In a high appreciation market like South Florida, this allows you to control a large, valuable asset and build equity immediately, using very little of your own cash up front. But there is a clear operational trade-off. To secure that low down payment FHA financing, the property must pass a strict condition appraisal. Fixer-uppers usually will not qualify. Then there is the lifestyle cost. You are living wall-to-wall with your own renters. You lose a degree of personal privacy, and you are always on site when a maintenance issue happens. If you are willing to trade personal comfort for a low capital entry point, house hacking provides a functional path to owning a significant asset while your tenants cover the mortgage. This chart illustrates the binary risk of a single-family rental. When your one tenant moves out, your income instantly drops to zero, paying the mortgage out of pocket. A multifamily property splits your risk. If one tenant leaves a fourplex, you maintain 75% of your revenue. That protection is why investors focus on net operating income, or NOI. You calculate NOI by taking your total collected rent and subtracting all of your operating expenses. But insulating yourself from vacancy risk comes with a direct cost. Multifamily properties have significantly higher baseline operating expenses than single-family homes. You are now managing multiple leases, coordinating maintenance for 2, 3, or 4 separate households, and dealing with accelerated wear and tear on shared systems. A lot of first-time buyers fail here. They calculate their expected returns based purely on the gross rent coming in, and they completely underestimate the cash reserves needed to maintain multiple units. Multifamily units successfully protect you from catastrophic vacancy, but they demand a much higher standard of ongoing operational management to keep that NOI positive. Out-of-state investors often look at South Florida properties and make offers based entirely on national average yield calculations. They miss the single biggest threat to local profitability, the South Florida insurance tax. Because of specific geographic elements, namely flood zone designations and proximity to the coastline, insurance premiums here are drastically inflated compared to the rest of the country. Securing coverage at all requires strict adherence to hurricane building codes, and the age of a property's roof can determine whether a policy is even issued. This chart shows what happens if you ignore these details. You start with an idealized profit breakdown. Then the actual local insurance and tax costs hit, aggressively expanding and completely swallowing your profit margin. These localized costs are unavoidable. They have to be calculated with exact numbers before you ever submit an offer. Winning a bid in Miami-Dade or Broward is a challenge, but shielding your cash flow from these hidden costs is what actually determines if you stay profitable. Another common approach is the value-add strategy. This means buying a distressed property below market value, renovating it, and forcing the appreciation up. The local roadblocks here are severe. South Florida is notorious for intense permitting delays, high labor costs, and strict mandates for structural upgrades when you open up walls. Alternatively, some investors focus on Section 8 and workforce housing to secure government-backed, recession-proof rental assistance. The trade-off for that guaranteed income is heavy administrative oversight. You will deal with mandatory recurring government inspections and strict compliance management. Value Add and Section 8 can produce superior returns, but only if you are prepared to function as a full-time project manager and compliance officer rather than a passive owner. This chart maps out exactly how to survive the South Florida market. Success requires aligning your investment strategy directly with your exact capital constraints and lifestyle goals. If you are a local beginner with limited cash, but you are willing to manage people directly, you should pursue the FHA house hacking strategy. If you are an out-of-state transplant flush with capital, but you lack local operational knowledge, you should look for turnkey multifamily properties with professional property management in place. And if you are an exit investor seeking maximum appreciation, only then should you attempt taking on distressed value-add properties. Multifamily properties in this market offer a concrete path to scaling your income, but only when your choice of property matches your actual budget and experience. National averages and online spreadsheets will not protect you against local South Florida realities, like flood zones, strict zoning laws, and condo regulations. That is why you need a local specialist. Ben Ezra of Sell State 360 Realty brings 16 years of hands-on experience in Broward and Miami-Dade as a realtor, a landlord representative, and an active investor himself. Ben specializes in helping investors identify hidden risks, evaluate realistic rental income, and avoid overpaying in a highly emotional market. Reach out to Ben Ezra for a personalized market analysis and accurate deal underwriting. Make sure your first South Florida multifamily purchase builds true long-term wealth rather than becoming a costly liability.